Welcome to the latest Wealthwoke video. Many people believe that indexation should be the cornerstone of any investment portfolio, but do we really understand what it means? I sat down with Cassie, Treunicht, portfolio manager at Gryphon Asset Management, and asked him to unpack this concept. Watch the interview, enjoy. Cassie, indexation is quite a broad term. What is your understanding of it?
Okay, from an investment perspective, indexation can basically be unpacked in three different terms. We used to know indexation as a previous term called passive investment management. That since then evolved into something called indexation, which we nowadays call more rules-based investing. So rules-based investing basically means that you're investing according to a set of rules, whether it be maybe based on quantitative measures or maybe based on an index that you actually have to construct. It means that you're basically following a predefined set of rules which is transparent for investors. So if you, for example, take a fund that follows indexation or rules-based investing, what it does is it defines what the market is or whatever that segment that it specializes in, and it follows certain weightings that is defined by rules.
Okay, so give us an example of what an index that you would track would be.
What we believe is when you do indexation, you want to look at the overall market, because really defining where your entry points of these subsets is, whether you're going into financials or you're going into resources, your timing have to be perfect, and investors never get that right. So what we say is track the entire market.
So whether it's the JSE, the Aussie, or the MSCI World or something, those are the big broad markets, you say?
Big broad markets is what we define as proper vanilla indexation, which works over the longer term. That's the only thing that history has actually taught us. So if we take it, for example, from a South African perspective, you want to be following the all-share index. You don't want to use certain subsets. You don't want to cut it up and use smart beta investing. Your entry points will always be wrong. So follow the entire market, and indexation will do those weightings for you in terms of how the markets develop. So what it does, for example, is winners constantly get up-weighted and losers get down-weighted. So you get the best optimal portfolio for a long-term strategy of investing into the market. So what investors sometimes ask me is, what is the best long-term strategy to invest in the South African equity market? What I always tell them is follow a broad market index, the all-share index, not a capped index, not a shareholder weighted or otherwise deconstructed or reconstructed index. Use the entire market and invest constantly, maybe on a monthly basis, put a debit order in and follow the entire market through time.
What are some of the other advantages, disadvantages in a summary?
I'm going to start with the disadvantages, because indexation, because you are following the entire market and it's 100% invested, it is probably a bit volatile at times. But that's not the point. The advantages is what we should really talk about here. Is we've seen this and we've done hundreds of research papers on how, and we've seen them everywhere. It's not just a South African thing, it's a global thing. Indexation beats on average between 70 to 90% of all competitors throughout time. So it's more a consistent performer. What you'll find is certain active funds outperform the market, and then they go through a stage where they underperform the market for a longer time. But you add those two periods together, you'll find that they underperform the market by a substantial margin. So what indexation does is it consistently beats the pack, 70 to 90% of them. So what you don't want is, you don't want to be caught up in a scenario where the market might run, but the fund that you invested in does not perform accordingly. So then you've missed out on your gains, and that's what indexation always gives you. It's the best performing asset class over time, and that's where you want to allocate a big chunk of your core portfolio.
So you don't see too many disadvantages, or there must be some, right?
I think some of the active managers, what they would always say is, right, when the market experiences a drawdown, you'll see that, okay, fine, active funds can perform better during drawdown periods. But the problem is from the peak, where the market starts going down, and the bottom where it starts going up, they cannot always get the exit point and the entry point correct. So what they might do is they get the exit point correct, but when the market starts running again, it's too late.
So I guess it comes down to that whole efficient market theory. But in South Africa, do you think that markets are still efficient, or do you think that there are pockets of opportunities for active managers to sort of utilize?
I think it's a very important point you're making, because if you look and think about it logically, it's pure logic sense. Whether the market is efficient or inefficient, it's still a zero-sum game. So you might have managers that outperform, but for every outperformer, there must be an underperformer. So it's still a zero-sum game. Right, getting back to efficiency, I think the US is probably the most efficient market in the world at this point in time. And what we see there is in excess of 40% of assets are already invested passively, indexation, rules-based. But still, only 80% of managers still underperform the benchmarks, markets, or indexation. So even for a very efficient market, indexation works, and then even for inefficient markets, it also works. So there's benefits, South Africa, as a relatively more inefficient market, you still have the same dynamics at play.
So you say 40% of funds in the US are in passive funds or in index funds or index trackers. Yet in South Africa, I'm pretty sure it's far, far less. Why are South Africans so late in waking up to these benefits?
It's the distribution network. So what you see is, for example, some of the biggest fund managers, just by the way, a fact, 4 of the biggest funds in South Africa own 30% of the assets under management. And it's not because of our performance, it's not because of certain individuals, it's just purely because of good distribution networks.
Yeah.
They might have been a good performer in the past, but they're still managing 30% of the assets in the general equity sector just because of good distribution.
Okay, now explain to me, if I want to follow this passive philosophy, I can either go and invest in an ETF, or I can go to a fund like you offer, like Gryphon offers, which is more of a passive fund.
Yeah.
What is the difference between the two, and why should I invest with a passive fund manager rather than just going straight into an ETF?
Okay, so ETFs and unit trusts are essentially both collective investment schemes. The one is just on the market where you can buy and sell it. There's bid and offer spreads, that's between the two. And then you've got a unit trust where it only gets struck a price once per day. But both are focused on the concept of keeping costs low. However, if you want to trade an ETF, you first need to have a brokerage account. That's going to cost you money. Secondly, when you trade them, you're going to have to pay a trading fee. You're going to have to pay taxes, investor protection levies, etc. And then thirdly, you're also going to work with a bid-offer spread, or you might even suffer from market impact. So what we are saying is, what is the best cost-effective way of getting an entry to the broad market? And we feel that is from a unit trust perspective. The unit trust perspective have other benefits as well. I mean, because it's a unit trust, you have trustees literally protecting your assets and looking after your assets. So what we say is, rather go for a low-cost unit trust instead of going for an ETF, which is also, on the face of it, a low-cost structured product. But there's certain hidden fees that the investor is not always aware about. Yeah, you can buy and sell them whenever you want to. But because indexation is a long-term product, what you really want to do is you want to just go to a unit trust with this lower fees at the end of the day.
So you're saying there actually isn't even a premium a lot of the time for a passively managed fund than there is for an ETF? When all costs are added in, sort of the total expense ratio, we're looking pretty similar here.
Well, no, what we are saying is when you add your fees for your ETF, in actual to hold that ETF, the fees are substantially more than what people really understand. You need to look at the entire package of getting that exposure. It's not just buying and selling and what you're in and what the fees, annual management fees are per year. You need to look at the entire package of fees. So, I mean, if you have a brokerage account, it makes more sense to buy an ETF, but you still have to pay trading fees and you still have to work with that market impact. What we are saying over the longer term, just go into a unit trust. That's what our belief is.
So one of the issues I have when I go into an ETF is that I'm also afraid of, they all seem to be sort of essentially 100% equity. When you go into an ETF, whether it's the All Z or global ETF. If you invest in a passive fund, is that
it's exactly the same thing?
Yeah, is
so
that the same?
you get market-wide, broad market ETFs, and you get broad market unit trust. They're exactly the same thing. The difference is just in how you're buying that. Whereas for unit trust, you can do debit orders monthly, or you can do lump sum movements. It's just a way of how you're buying or selling into those two products. That's the only difference between them, and obviously the higher or lower fees.
Okay, so last question. How has this philosophy worked for you over the last 5 or 10 years? What has the performance been versus active managers?
Well, exceptionally well. Like I mentioned earlier, 70 to 90% of the time we are beating, all of the time we are beating 70 to 90% of our peers. So if you, for example, started investing into a passive fund 10 years ago, you are now way far ahead than your friends that's still making use of active funds, unless they've been very successful, which we don't really ever see. You take a couple of funds together and you evaluate that performance versus indexation. Indexation will always come out on top. So you really need to make 1 or 2 good calls on active funds over, let's say, 10 years, which is incredibly hard to achieve. And the moment you start using more funds, you're using the market as well. So just use a passive fund anyways. So what we are saying is, and the evidence speaks for itself. I mean, there's hundreds of research papers on the internet available, and we've got a fan actually, one of the best active managers in the world, Warren Buffett. Actually, he's in favor of indexation.
Yeah.
He's telling people, he's putting it on the table. He in fact had a bet with a multi-manager in hedge funds. Over 10 years, the first year I think the manager won, and then every single subsequent year he lost out. So it basically came down to the fact that Warren Buffett beated his bet against another guy that was selecting active funds. But the point of the matter is that when the most successful active manager in the world of all time tell the investing public you should be making use of indexation, you should maybe listen up.
Cassie Treunicht, Portfolio Manager at Gryphon Asset Management. Thanks so much for your time. Busted a lot of this there for me, and a lot of food for thought there. Thank you again.
Thank you. Pleasure.